All right, how's it going, everyone? I hope you're doing very well. So now we understand how you should be case studying a lot of your trades at the moment, which means that we can start to go a little bit deeper into understanding overall usage of EVC as well as entries. Okay. Now, for entries, because of what we've already learned, this is fundamentally everything you need about entries. And as well as that, in this video alone, I'm just going to simply show you how you can start to properly calculate risk in the event that you're already trading your systems, actualizing your results, doing your back testing or your forward testing with a firm, whatever it might be. Now, for your entries, for the most part, every single entry will follow or look something along the lines of what you see here. So this is where you're also going to be introduced to the ATR. On your trading view screens, within your trading view settings, when you've added the MenthFX Premium Structure Indicator, what you'll have is at the very bottom, you'll have this additional option for the ATR value. You can just stick that on and it will be set to the chart. Very simply, when you look at the bottom right here, this is the ATR at the moment. This is a measure of how much this given asset moves over the last 14 bars or so. So to put it very simply, it is an average measurement of volatility. How much, how volatile, whether it's tiny or big, does the given market move? So you know, on average, what this thing actually moves. And the reason this is very important is because this is what helps us keep risk somewhat consistent in and when we take an opportunity. That way, for instance, if you're entering, let's say, this double MB right here, let's just say this is a double MB you enter, right? There may not always be a full understanding of where your stop should go. Some of you might put your stop down here, some here, some here. Some of you, as you test and you start to get better and better at doing this, right? Whether you want a much bigger stop with a potentially higher win rate, much lower stop with quicker break evens, with larger moves when you get them right, whatever it might be, right? You want to have a general understanding of where the stop should be. Now, this stop, and what I've personally done in my own trading, is and should be based on a multiple or a range of the ATR. Now, again, it does not mean that when you look at this number and you see 4.6, that when you take an entry like this, let me go like this, when you take an entry like this, that the actual stop itself, which you can see right now is at the 7.18, has to be 5.46. It does not have to be like this, 5.46. When I say that we use an ATR to give ourselves a general measure of volatility to use for our actual sizes, what I mean by that is that you can use any multiple of this ATR to work out for yourself what you're going to do consistently over your time as a trader. Right. So this is why this is in the entry section and why we can finally introduce the understanding of ATRs. But very simply, right, my average stop from what I do when I take a trade is now, well, it used to be around 1 to 2x the ATR. So that means that if we look at this number of 5.46 and we go open up the calculator and we take 5.46 and we multiply that by 2, very simply, all my stops, no matter what, on this given move at this point should be between $5.46 and $10.92. $10.92, right? So that means that my stop usually would have been from here up till here, and that could be a valid stop loss for me in terms of where I'm going to put or exit my trade. That's what a stop is. It's where you're going to exit your trade if it goes against you, and you're not able to do anything else in the trade, right? So this is how ATR comes into our understanding initially. Now, with continuous testing, with continuous trading, with continuous of doing this over and over and over again, and with the way that I personally manage trades, what I found is that I always lean more towards a 1x ATR multiple for my actual trade. So what this simply means is that when I take a trade, I almost always want to have an ATR multiple for my own stop loss at around 5.46. So in the event that I'm taking this trade right here as a double MB, right? So you form your first MB here, the second one starts to form, you take this, let's say, as a buy stop. I want my stop to be basically 5.46. Very, very simple. Okay. Now, again, what you're going to do for yourself, especially as you begin to case study, as you begin to study more and more trades for yourself, and as you use even the MenthFX screener to continuously find markets that are worth watching, that you then use to further case study on back-tested markets as well as forward-tested markets, and you get used to seeing it, right? What you're going to determine for yourself is what makes the most sense for a stop. Now, again, you can completely copy me and look for a stop that is in a range of like a 1 to 2 ATR, 1 to 2x, which is just 1 to 2x this number right here, or even just 1x, which is what this is, right? This right here is just 1x the ATR, which is 5.46, which is what I'm currently using for the most part, for every trade I take. So if I took this long, right, the stop would simply be something like this, around 5.46, and that would be the long that I'm getting into with that in mind. If I'm, for instance, trading FMB1 or FFMB1, FMB2, and I'm entering here, right, well, then simply my stop is going to be around 5.46 like this, right? So again, ATR is a measure of volatility. It's a measure of how much this thing on average moves. And you can then use that to actually decide what your stops are going to be to keep consistency across all markets you look at. That way, you further and even better understand this idea of it doesn't matter what market you trade, right? It doesn't matter what asset or time frame you trade. Instead, it matters the move itself, the way the orders are coming in, and in this case, the volatility of that move. So for instance, if you're looking at something like Bitcoin USD, which is this, crazy price thing, this thing is priced at what, 65,000 or whatever. And let's say you're looking at this trade right here as a double MB entry through this flush. So you get this flush and you go, okay, I got MB1. I want to enter on this MB2 right here. Or some of you might be looking at this FMB1, FMB2 right here, right? This just depends on how you're looking at the actual double MB that's forming and where you're okay with it forming and where you're okay with taking a trade. Some of you might be willing to take the trade right here at around the 1020 MA. Some of you might want to wait for it to pop up above and then come back. Either way, both of these could be valid trades. Let's just assume we're taking this one right here. So in the event that you're taking this trade or you're entering this trade, right, or you're setting up a buy stop here, right, it's not always as clear where your stop should actually go. Should my stop go here, 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 here? Do I want to make it here? Do I want it to be super tight? Should I put it under a point? Should I put it at the MAs? What I do, once again, is I look at the ATR, and you can see this is now accounting for whatever the asset's price is. So in this case, it's around $2,266 because this is Bitcoin. So, it's in the thousands of dollars. And simply now, right, I can set this up as 2,266 and my stop loss could go there. And that could be my trade and whatever, right? You get tapped in, you might move to break even, right? And then you let this thing do whatever it needs to do. And maybe it comes back and maybe it sets up again, right? And you do the exact same thing. And as it's setting up a potential move, maybe it sets up the FMB1, FMB2, right? You look for a trade off of this. This is now at 1958. So you can see with price passing, this updates to account for the volatility of the most recent number of bars. So in this case, the most recent 14 bars, because that's what the ATR is measuring. So now it's at 1958. So I could simply go ahead and set this to 1958, or you can use a 1x to a 1.5x, right? So this is where a range or an understanding of a range might be helpful to you. So if any of you guys have decided for yourself that you tend to do the best when your ATR or your stop losses are around a 1 to 2 to 3x ATR value, then simply, right, your 1958 times 3, right? So your stop loss should be 5874 or less, right? So some of you might have a stop like this, and that might be your entire edge. This is where you might have your edge, and you might want to have some of these like longer period holders that you're willing to hold on to, give a move potentially some time, and then as it starts, right, in case that wasn't the real move, maybe it goes through another flush, sets up, and then it starts going, you move to your stop to break even, and then all of a sudden, you get your move. Then great, you now have the opportunity to do that, and now you understand a way to measure proper stops through a volatility-based metric, which is the ATR, which is why it's included in the tool that's available to all of you, right? And then of course you get your move, and you follow this as you need to, right? And this is exactly how those moves. This is exactly how those moves happen. So now, when it comes to real entries, and you've now seen some normal case studies, but also some examples of entries that you can take using the understanding of what creates an actual double MB and how that can be an FMB or an FFMB just based on the setup in terms of where it's happening, right? Every entry for the most part will look as with the ATR now at your disposal like this, right? For the most part, your entries are going to be something along these lines. When we're talking about a buying-based market, you have the formation of some kind of MB, and you enter through the buy stop. You buy stop, which is considered a market order, through the second MB. And now, as you can see here, you can have a stop loss at 1x the ATR, a stop loss at 2x the ATR, a stop loss that's based on maybe the MB or half the MB or something like that, right? But this is where this ATR measurement comes in. And then once you have that determined for yourself, you actually start building some bit of consistency upon what your trades are going to look like, right? Because the most important thing in trading, even though it's a very, what do we call it? even though it's a very discretionary based skill set or discretionary based thing that we do, the discretion only is important in that each individual person has their own system, but the person trading their own system, so that would be you trading your system or me trading my system, has very specific rules under which they've tested an environment, understood what they want to trade, and how they want to trade it. So you get very used to understanding if you're using a 1x ATR measurement for your stop loss, you get very used to seeing what it should look like at the time of entry, right? Like I know looking at this that this is a good trade. And the reason I know it's a good trade is because one, it's meeting the cycle. Two, it's meeting the double MB setup. Three, when I'm taking this, if I'm taking this buy stop, and I look at that 1956, the place where it puts my stop, kind of under those MAs a little bit, under some of the candles here, lines up for what I expect the move to actually look like, right? So this comes back to case studies. So because all of those things align, and my 1x ATR stop loss based measurement that's based on that volatility, the ATR, is lining up basically perfectly for what I expect out of a move. This is a move I'm more than happy to put money behind and let it do whatever it wants to do. And now if the daily actually becomes your validation time frame. So again, this would be assuming, right? This would be a good entry, assuming this is an entry time frame, right? Because in this case, what we have is we have that flush out. It starts building those MBs and it provides an opportunity here. So this would be a good entry considering this is an entry time frame. If we simply change and decide that the daily is now our validation time frame, right? That means that we have an entry time frame that should be around, so what's 24 hours divided by 6, right? Right, so maybe around 240, so that's about 4 hours. So we know that on a 4 hour now, the times where it's probably going to start making sense to look for accumulation-based entries would be where? Well, it'd probably be inside of, let's go like this. So again, this is where we start getting a little bit more deeper into how you're actually using the cycles, understanding them across timeframes. We'll make one more video within this section on accumulation MBs and momentum MBs and marrying all the cycles together because they're all happening at the same time. It's just we're interested in different parts of the cycle when we're looking at the EVC across a given move, right? So we know that an entry-based time frame, if the 4 hour was an entry-based time frame, when would it probably produce the best opportunities? Well, the best opportunities would probably present themselves right here on this first accumulation or momentum MB. So this would count as like maybe the first sideways bit of let me show you guys this, of a buildup of this right here. So this would kind of be this number one or this first base that's happening kind of as an accumulation MB on the C or the V and is now acting as a good enough area to look for an entry, right? So we know the 4 hour is going to be good here. Maybe it's going to provide something nice here, which is, I think, what I drew on here. If I go to the 4 hour now, as let's assume this is the entry time frame now, right? What do we start to see? So in this case, there isn't really that clear of an entry here. So this is where maybe you have a little bit of a lower entry time frame. So maybe go to the 2 hour just for a second. Okay, beautiful. So if I go back here, right, this is a beautiful, beautiful part of the cycle. So assuming the daily is now assuming the daily is your validation, right? And what you end up seeing is something like this that's happening. Well, now the daily is potentially moving into a worthy trading environment for an entry time frame on a lower time frame, which would be the 4 hour in this case, entry time frame. Or as we understand, because of the EVC understanding, this can be maybe a 2 hour, a 4 hour. In some cases, maybe you can even allow 1 hour to be clear for an actual entry, because again, the timeframes are not always going to be perfect, but it's an understanding of how the orders are moving into the market, right? So we know inside of here, the 1 hour, 2 hour, 4 hour is likely going to be undergoing that beautiful major flush that created the anticipation of a higher low because there's overall accumulation. That is accumulation that starts some kind of stage 2 into stage 1 to stage 2 to start that actual move higher. So if we go to that 2 hour or that hourly, right, even that hourly, it doesn't really matter. We can look at the move and we can understand if it makes sense to stay on this time frame or move up or down. And what we see, right, is we do see that kind of major flush come into the market here. That does create some kind of anticipation on the higher low. So clearly we know there's some accumulation happening here. Then all of a sudden you get this beautiful stage 2 push. The stage 2 push leads to, as we understand, a flush. The flush leads to the potential of MB creation, which it starts doing, MB1, MB2, which is perfection, or you're looking at a 2 hour because you're a little bit uncertain, so you wait. And you kind of get this maybe MB1, FFMB2. So again, what you do is you set up a trade, right? So you take a buy stop through the high, and this is simply This is simply this, but prorated to this right here. So you can see how your entries are, for the most part, always going to be the same thing once you understand what actually creates an entry, because this is simply demand validation, or the potential or the anticipation of demand validation, right? Where you have an MB form, a second MB forms. And again, how do you determine which ones of these MBs or these double MBs are worth buying? This is where other tools come in handy. This is where the screener shows us if something is worth taking a look at or not. Then we measure that across potentially relative strength, and we'll talk about that later. We take a look at what that looks like in reference to the entry timeframes, moving averages, and where they are. We talk about in reference to where is the validation times, moving averages, where are we in the cycle. These are all aspects that lead us to decide whether or not it's even worth to take any kind of double MB or double MB setup. And in this case, right, this is the exact setup that's happening right here, which is this one right here. And if we look at this, the ATR is around 399. So again, if I wanted to take a play on this, I'd probably put my ATR on 399. And as I look at this, it's the stop ends up not behind the candle necessarily, but it does end up kind of around the moving averages. And this is all in line with what I've naturally seen happen for my own good trades. So because of my case studying, and now because of my risk management side, which is an understanding of how I'm using this volatility-based metric to actually put my stops on, right, I'm happy to execute this trade. Otherwise, for some of you, maybe you've noticed that a lot of your good trades, because again, this is discretion-based, this is a lot of this is based on you getting better at seeing this for yourself. A lot of you might notice that your best trades don't end up looking like this. A lot of your trades are where like a stop loss protects some more lows. So what you can do is you can simply cancel this trade and wait for something to actually be created. Because remember, right, this now is becoming what? Instead of this being one of these entries, all it's doing now is it's acting more like this entry again, right? Because again, an FFMB or double FFMB based entry can become simply a normal double MB based entry, okay? Now, again, if you set up a long here and you look at the ATR, it's around 400 now. If we make that 400, right, that puts you around here. So again, this is one of those points where if you're not used to having a stop that is kind of inside the MB, right, and not even protecting under the MAs, you might make the choice to not take this at all, right? That's perfectly fine. There's nothing wrong with that. Now, personally, I'm okay with it. I'm used to it. So, this is something I'd be willing to likely take. And then, of course, we look at this on the hourly, right? You had that initial move here, right here, which might have been valid for you to take, and you might have taken that already as a long. So again, this is where a few different timeframes can come in handy. But this is just a simple measure of volatility, and this would be the move that validates this overall cycle in the entry time frame, and then starts playing out the cycle of the validation time frame, which can lead to your either profits now or you hold based on whatever rules you're specifically using, and that might be your move. And then that move continues moving, and as it pauses once again, like something like this, as it pauses once again, this can become the same kind of area. So like if I go back here as it started to pull back, we know that this is going to start a potential cycle move for a 1 hour, a 2 hour, or a 4 hour entry on the entry time frame, right? So if we look at like the 2 hour again, same thing as we did before, we take a look at what's going on here, right? We start seeing that same thing. Price kind of flushes out, right? This in this case is a bigger flush out than the flush out we saw here, which is okay because we can't predict how the flush out looks, but what's cool is we have tools in place to help us decide if we're even taking an entry based on the move. So right now, right, if you notice when this flush out started, there wasn't even really a double MB that was worth taking except for maybe like this one. And yes, in this case, you might have taken a stop out or a loss, and that's part of the game. But right now, I haven't seen anything like that. So this might be still a market that you end up waiting on. But as you're looking at this, the cycle is playing beautifully, right? So you look at this and say, okay, this is likely flushing out, and I can look for entries as this begins to create double MBs off the lows here. And then all of a sudden, you get kind of this MB1. Well, you already get this FMB1, FFMB2, or FFMB2, which we would have missed in this case. And now you have this MB1 right here, right? Maybe this MB2 right here. And as this MB2 forms, right here, and you take a long or you set up a long over this high and you look at the ATR, which in this case is 575, and assuming your rule is also to do a 1x the ATR, which is 575, and you put it on there, maybe as you look at this, you're like, okay, this looks very in line with what I want to see. I'm more than happy to take a trade on this, so I'm going to take it. Otherwise, some of you might be like, okay, I don't like the fact that, in this case, the entry itself has a stop that's not even protecting an MA. And for me, that's not good. So as a result, I cancel the trade and I don't want to do anything, right? That can be a perfectly fine rule. And then all of a sudden you start going into a bigger buildup of a double MB, which is now basically this entry right here, because every entry for the most part fits one of these. Is just that we don't know exactly how it's going to look perfectly, but there's an understanding of, this is the snowflake rule. You will have setups that all act as the same thing, but might look a little bit different, which is okay, because that's what you are testing. And again, volatility based, if you look at the measurement here at 550, you look to make this around 550. So again, I'm looking at this number right here. This number right here is the one that I'm using, and I look at this to be 550. This might be a move I'm more than happy with taking. Sure, whatever, right? You get tapped in, you start actually managing your position. It moves into profit, so you move yourself to break even. So you take off your risk, and you're just sitting right here, just waiting for this thing to either go or fail, right? It fails back down, so you end up out of this trade. Or for some of you, as I said before, your measurement of volatility might be to use an ATR of around 4x the multiple, for instance, maybe 3x the multiple. Now, I don't personally do that, but this is very important, because once you understand this, you open yourself up to the opportunity of what makes the most sense for you. Do you like to have tighter stops when you enter something? Do you like to be stopped out quickly, to have it go in your favor? Or do you prefer to let something really try itself? You don't really take risk off instantly. You just kind of let this thing decide what it wants to do. You either let it come and lose for you, or you let it come and set up a new position. And then all of a sudden you might have a move that, you can actually, that starts, and then you can move your risk off, right? So these are perfectly viable and fine options, right? For me, this would have been a trade that would have just simply ended up as a break even. And then as I continue watching it, right, what do I get? I get a new flush out into what? An MB1 or an MB1 into MB2, and this just acts as a new setup. And if I took this setup and I look at the ATR here of 372, which is the volatility, and I look at where the 372 is, right, this is a perfectly fine stop in terms of where it is, what it looks like, in terms of what I'm used to from my case studies. So I'm more than happy to take an entry on this and have it do whatever, right? And then, either it goes, which it does in this case, and then I get to manage and make money on it, or it doesn't go and I just get to sit on the sidelines and do nothing again, kind of like this one right here. And these are, three examples of the same thing happening. You entering through the cycle using the cycle of the E and the V in this case. We're not even looking at C just yet. But again, right, it's also a further showcase of how these cycles interact together. Because notice that this cycle on the daily began with the accumulation MBs in the full, it had its initial move up, right? It had a flush down. It started to make accumulation MBs. The accumulation MBs later, the ones above the MAs, acted as either accumulation or momentum MBs, which started to act as potentially a lower entry timeframes, right? If we treat the daily now as a validation timeframe, it started acting as the lower entry timeframes, accumulation MBs and setups on a lower, that then create that cycle, which led to these opportunities, and then led to the play out of this cycle that you now get to partake in as it keeps going, or as it finally fails and resets a little bit later, right? Because that's how markets operate. A very beautiful thing. And yeah, right now you can see it's kind of resetting and just falling down, which is perfectly fine. So this is how ATR is actually used in our trading. This is how I use personally the ATR, and how I personally conducted the case studies, because I've learned to see what the ATR measurement is going to provide in terms of the setup look, where it's going to naturally put the stop when I'm actually taking a trade. And as a result, you get to this right here, which is your understanding of what your entries are usually going to look like. Almost all, like I said before, are based on this kind of double MB setup, right? The double MB setup through the buy stop. The double MB setup, where the first one's maybe an MB, the next one's an FMB, the buy stop. Your stop loss is a measurement of the ATR, or your own preferential stop loss, right? Because that might be you. But personally, I like to use an ATR-based stop loss with a range that you choose, or a number you choose, right? Some of your entries might be a double MB within what looked to be an initial MB. So you take the entry through here and then you have your stop. Or in some instances, maybe this ends up being an MB and you're not so certain about these two MBs that were forming inside. So instead you wait for this one to complete and FMB begins to form, right? MB1, FMB2. So you take the opportunity and you look great. Again, this is one of the examples we saw today that didn't end up actually working out because it became a double MB, right? Because this is that example where this became this. But in the event that you have something like this and you take the candle, right, you have an MB1, FMB2, just like you learned in the last few portal videos. This is another type of entry that you can also use. I've seen some members here use this and are profitable with this, where basically you have MB1, MB2, but nonetheless, you still wait. You wait for it to start actually moving, and then you enter. And then you have the same thing. You maybe make a stop with an ATR, or you make a stop using an MB, just up to you and preferentially. I do not usually use this at all. I actually very rarely use this. The only times my trades might look something like this is if I got slipped on a trade. But this is also a valid way to look for entries. Or something like this, where you have these MBs forming, but you're not sure about them. And if a big MB1 forms, as a second MB is forming, you start getting this beautiful FMB1, FMB2, and you enter a trade. To give you a quick example of this, just to showcase it, what did I take that looks somewhat similar to this? I know there's been something somewhat recently, probably. Maybe something on MSTR. Let me see if I can find you guys something. Okay, there's not really a good example here. However, if I was to try and just bring the closest one of something like this to your attention, it'll probably be something like this, right? Where you have kind of this, maybe you look at this as an MB1 and you just weren't sure about it. And then you're viewing this as an MB2, right? So that's this kind of setting up. And then within it, you kind of get this flush. In this case, the flush doesn't even come to the averages. So maybe you skip this, it's not even that good of an example, but simply, right, it comes down and you look at this as a FMB1, FFMB2 or FMB2, and you enter the trade through there. That's just an example of that, right? Where you have kind of that larger double MB forming and you take the double MB inside of it. Because again, these are all fractals of each other. That's how these markets work, okay? So this video, like I said, is a focus on what your entries are almost always going to look like, which again corresponds to exactly the things we've spoken about before. Case studies showcased of every opportunity on its own. So again, well, this is actually a good example of the thing I just looked at with you guys, where if you take a look at this, right, what you have is you can have this as the MB1, and as the larger MB2 is forming, which, in this case is the one I actually entered on, but as it's forming, what you also have inside of it, let me make it red, is you have an FMB1, FFMB2, and that can act as an entry. This is where, the first MB forms, the second MB is forming, and it's quite big, but because of the flush that happens inside of it, that then starts to create this double MB inside of it, this becomes a valid trade, and then you get a beautiful move out of it. So that's a good example of the thing that I was talking about a little bit before, right here on the right, which is this guy right here. But overall, if I zoom out and you take a look at this is just an example of what entries are going to look like. And you can see that all of them are based on that same understanding of that double MB forming, right? And for personal stop sizes, like where am I actually putting my stop? How am I deciding where my stop is going to go? It's always based on a multiple or simply on the value of the ATR. So if I'm taking a trade today on MSTR today, right now on this time frame, I'm taking an entry, right? There isn't even an entry, but let's say I did, right? MB1, maybe this is MB2, and I want to take a trade and I take the long through here. My stop is going to be 2.18, and 2.18 puts me right around there. Now, at the time when this price was forming, that actually might have been a perfectly viable and fine trade. And this is a trade that I'd be more than willing to partake in and take as an opportunity. And, as it does its thing, I either get to manage myself and then it gets to make me money, or it comes back and there's nothing to do, or, I just take a loss on it, because those are the only three outcomes of any given trade. And that's perfectly fine. But that is how I would determine what my stop should likely be. And then again, when you determine your stop, what's really cool about that is as you determine your stop, you can also use that as part of your case study of what your trades should look like for proper moves. So what I mean by this is in the event that, we're looking at this trade right here. Right. So again, I got a little bit slipped on this one, but let's assume the entry was here. At the time, the ATR was, well, this is, it's now the measurement of the one in the future. But at the time, let's say this ATR was, I don't know, it doesn't really matter, like 0.5. Okay, 0.5. And let's say 0.5 put my stop loss at the time of entering here, right here. I am more than happy to take that trade because I'm used to seeing a stop loss on a good trade look something like this in reference to the setup of the overall MB within the cycle. So because those two things align, because this is another factor of your own trading, because where I would normally put my risk based on the volatility measurement lines up with what I'm used to seeing in terms of where my risk should go for trades that do work out well, I am more than happy to take that trade because it's clear. And as a result, I get in, I follow my rules, and this one ended up being a very nice runner. Similarly, If I took something like this one right here, right, MB1, MB2. Let's say I took that. At the time, the ATR maybe was 0.3. An ATR of 0.3 might have put the stop here. Would that be something I want to take? Yes. Why? One, because it meets the cycle that I'm looking for. It meets the setup for the cycle that I'm looking for. It's doing it in terms of where I wanted to see the moving averages, these lines on here, the 10 and 20 specifically, about where they are. I'm more than happy to enter because of that. And at the same time, the stop loss itself protects either at or inside the MB while being kind of under or at the MAs, which it is. So this makes this trade really, really good, more than happy to take. And that would be one that I'd be happy to execute, not just because it aligns for the cycle and everything else, but because it also aligns with the other case studies I've done of a stop loss with a volatility measurement of around a 1x ATR, which is why I introduced this to you now. I want you to get used to understanding what size your stop is. If you're very used to being a trader where you take an entry and you just throw your stop wherever, and you're doing well for yourself, and you've taken photos, go back and look at those entries, look at where you've taken those entries, and literally look at what the ATR multiple was. Because what you might notice is some of your best trades might have always been a 2x ATR multiple or around that. And then you can also now use that for your case studies to know where the stop oftentimes goes. So now going forward, it's part of your overall system. This is how you get very, very good at a discretionary based system, because you make it you create a pattern, and you create a basically a full rule-based system for yourself out of that discretion, right? This is how you use the ATR. There it is. And now that you understand the entries, what entries will almost always look like in terms of the entries themselves, right? And how to use the ATR to set the risk. We're going to talk now about how to actually calculate risk, given that you're doing this on any given asset, to make it really simple for you. And we will move and go from there. All right, I'll see you all in the next one.